Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Stephen Hale, who's a lecturer at the University of Adelaide School of Economics and a modern monetary theory economist. Stephen, welcome to interest.co.nz. We certainly appreciate your time.
Thanks for having me, Gareth.
Yeah, modern monetary theory, or MMT, has been in the news quite a bit recently, in large part due to the book by Stephanie Kelton, the American academic and economist, called The Deficit Myth. So I thought it'd be really interesting to talk to somebody about MMT and get a feel for what actually it is. So that's probably the best point to start. What is MMT?
MMT is, we often say, a lens for thinking about macroeconomics and understanding particularly the role of the government and the government budget in the economy, and for understanding our monetary system. And MMT economists argue that what people think of as the orthodox approach to discussing these issues is, where the monetary system is concerned, 50 years out of date.
So one of the key points that Stephanie Kelton makes is the difference between the central government as a currency issuer and households, businesses, and state and local governments as currency users. Why does this difference matter in MMT?
It's not even just that. For governments like the Australian Commonwealth government and the New Zealand central government, that they're currency issuers, they're a particular type of currency issuer. They're what we call full monetary sovereigns. Just dealing with the currency issuer, currency user distinction first. That's perhaps the single important fact about economics which is most widely misunderstood by people. And that is that where currency users like you or I, or like a local authority, or like the South Australian state government, which is where I'm sitting at the moment in Adelaide in South Australia, are concerned, we're all currency users. So before we spend dollars, we have to go and get them. We have to earn them, or we can run in our past savings or borrow them prior to spending them. And if we borrow them, we have to repay them in the future. And if we take on too much debt, we can struggle to repay that debt. We can get into financial difficulties. We can potentially become insolvent. If you see a government that way, you think that the government has to raise money through taxes or has to borrow money by issuing debt before it can spend. And Stephanie Kelton uses the TABS acronym there: you tax and borrow before you spend. Well, if you are a state government like the South Australian government, or for that matter, if you're a national government which isn't a currency sovereign like the government of Italy, that applies to you. You have to get money before you can spend it. The Italian government has to get euros before it can spend them and can potentially become insolvent. There's insolvency risk there, at least if they can't guarantee the support of the European Central Bank, which they haven't always been able to guarantee down the years. But that's not the case with governments like New Zealand's government or like the Australian Commonwealth government, because they are currency issuers, because they sit at the top of the domestic monetary systems. Instead, as far as, for example, the Australian Commonwealth government is concerned, it spends dollars into circulation, which are new dollars. Every dollar that our government spends literally is a new dollar. So in Australia, prior to COVID anyway, the Commonwealth government was spending about $1.5 billion every single day. And every single dollar that it spent every single day was a new dollar. Not only when MMT economists talk, we say that they're adding to the net financial assets of the non-government sector, which sounds a complicated thing to say, but literally it was true that all the official measures of the money supply go up by $1 when the Commonwealth government spends $1, and the same thing is true in New Zealand. So you spend new dollars into circulation if you are the currency issuer. You don't have to go and get the dollars before you spend them. Later on, you delete some of those dollars from the system. Government spending creates new dollars in the monetary system. If the government just spends and doesn't tax, if it runs limitless deficits, of course, there'll be too many dollars in the system, there'll be too much spending in the economy, you'll go beyond the productive capacity of the economy, there'll be upward pressure on the price level, and there'll be inflation, accelerating inflation, potentially hyperinflation. So the role of taxation in the system is to delete some of those dollars from the private sector, to limit the ability of the private sector to spend, to create room within the productive capacity of the economy for the government to spend on public goods and services and infrastructure and all the other things that the government needs to spend on without creating inflation. We've got into the habit in recent decades of governments auctioning things called bonds, debt securities, to approximately cover the gap between what the government spends and what it raises in taxes. And we perhaps don't want to go into, unless you ask me separately, all the pros and cons of whether it's a good idea issuing government bonds to cover the gap between what the government spends and what it deletes from the system in taxes. Government bonds do play a useful role in the financial system. Amongst other things, they give fund managers, including superannuation fund managers that are going to be providing for people's retirement income in the future, attractive, interest-bearing, safe assets that they can hold over time. But governments like the Australian government and the New Zealand government are not obliged to issue those bonds to the private sector. The government could choose not to auction debt securities, and the government wouldn't run out of dollars under those circumstances. So the government spends new dollars into the system. Once those dollars are in the system, those dollars are available to pay taxes, and taxes play an important macroeconomic role in our economy, but they don't literally pay for federal government spending. And once those dollars are in the system, they're effectively transaction accounts at the Reserve Bank, and the government can offer the private sector transferable term deposits at the Reserve Bank, which is what government bonds are, in exchange for those transaction accounts if they want to. But again, the borrowing doesn't pay for the government spending. All it does is convert what is otherwise a transaction account in the monetary system into a term deposit. And when the government spends more than it taxes, it's just making a net deposit of new dollars in the banking system. We call it a government deficit. You could say it's a private sector surplus. They're giving us more than they're taking away from us. And the national debt, that's just the sum of past deficits net of surpluses. So the national debt is just dollars the government has spent into existence that they haven't yet taxed away. That's all they are.
Here in New Zealand, we've got a general election looming in September. And one of the big discussions, of course, this year is COVID-19. And over here, luckily at this stage, it's more about economic recovery than the actual virus, given the fortunate position we're in. But one of the debates is, how do we pay for this? And the government's going to need to raise more taxes and borrow more money. We're going to burden future generations with paying that back. What's your response to that argument?
It's complete nonsense. Utter and complete, total nonsense. What is a government deficit? As I've just said, it's just a contribution that the government is making of new dollars to the monetary system, a deposit in the banking system the government's making, if you like. Is the government going to run out of dollars? No, that's technically impossible given our monetary systems. I didn't mention this, I should have done. I said earlier on that our governments are a special type of currency issuer. Our governments are monetary sovereigns. To be a monetary sovereign, you not only need to issue your own currency, which you raise taxes in, you also need to have a floating exchange rate rather than a fixed exchange rate, which is true of both Australia and New Zealand these days. So you are not guaranteeing to convert your currency into gold or into any foreign currency or into anything that you could ever run out of at a fixed rate. And you also need to have no significant foreign currency denominated debt. That's not the same thing as saying no foreign debt. It doesn't matter who owns government bonds, not for this purpose, but it does matter what currency the debt repayments are denominated in. And neither the New Zealand government nor the Australian government have any significant foreign currency denominated debt. So what is the national debt that they are adding to at the moment? It is best described as the net money supply of dollars. It's dollars the government has spent in the system. They're not yet taxed back out of the system. As I've mentioned, they issue interest-bearing government bonds. They auction interest-bearing government bonds to cover the difference. They're not forced to. They could stop doing so. In recent years, in Japan, indirectly, because the Bank of Japan has been buying more government bonds than the new bond issues that the Japanese government's been engaging in. In recent years, the Japanese government's been running big deficits, and yet the amount of government debt held outside the Japanese government has actually been falling rather than rising. So if you don't like the existence of more and more government bonds out there in the financial system, don't issue them. But in any case, the payment of interest and repayment of bonds, all government spending in New Zealand will be new dollars. And those new dollars, if they're being paid in interest to bondholders, they're mildly stimulative in that you can spend those dollars in the New Zealand economy, and so potentially can add to inflation risk. But there's no issue beyond that at all. There can never be a crisis relating to New Zealand government debt. The New Zealand government can never become insolvent in its own currency. And it's not just MMT economists like me that will tell you that. It's right-wing conservative central bankers like Alan Greenspan in the US who've explained that in the past. It's Nobel Prize-winning economists like Joseph Stiglitz who'll tell you that. And actually, when you come to think of it, it's obvious. If you are the currency issuer, you can never become insolvent in financial liabilities that are in your own currency. And the issuance of interest-bearing debt is something that you choose to do. It's not something that you're forced to do. And repayments on that debt, what are you doing when you repay New Zealand government debt? You're just converting that term deposit back into a transaction account again. That's all. You're not doing anything else. It's not like a currency user getting into debt, where you can get into financial difficulties. It's not like the government of Argentina issuing US dollar denominated bonds. The repayments on those are a burden on future generations of Argentinians, because Argentina doesn't issue the US dollar and can run out of US dollars and has to go and borrow more or earn those US dollars in order to make those repayments. It isn't like the Greek government borrowing euros, because Greece doesn't issue the euro. Again, they're a currency user, not a currency issuer. It's completely different from the New Zealand government or the Australian government. Excessive deficit spending would show up as inflationary pressures. The deficit spending that the New Zealand government is doing at the moment, and the increase in what people regard as New Zealand's national debt, is inflation risk. There is no other risk, and while there's no significant inflation risk on the horizon, then not only can you be relaxed about deficit spending by the New Zealand government, and it's much better to think of it as a surplus for the private sector than a deficit for the government, but indeed the time to panic is if they try and rein it back. As I was mentioning before we started, it's not deficits in countries like New Zealand that are unsustainable, it's government surpluses. And there was a danger that rising fiscal surpluses in New Zealand prior to this pandemic were going to drive the New Zealand financial system towards a very fragile state and potentially a crisis which might have been combined with a collapse in the property market, because fiscal policy in New Zealand before the pandemic was unsustainable. The government was running a surplus. The rest of the world was also running a surplus on New Zealand's monetary system because New Zealand had a trade deficit on its balance of payments. Now, as we know, deficits and surpluses on the monetary system have to cancel out, basically because for every lender there has to be a borrower on the monetary system. And if the rest of the world is in surplus with New Zealand, and if the government is also in surplus, it means the private sector is in deficit. Now, that can be sustainable if it's businesses borrowing to engage in productive investment that's going to add to the productive capacity of the economy over time. But in recent, the borrowers in New Zealand households. New Zealand household debt is approaching the same level years. After the surpluses under John Howard has the world's second highest level of household debt. It's countries like Australia and New Zealand that have been at risk of a financial crisis, not Japan, the country that has the world's highest level of government debt. These are all monetary sovereign economies. Government debt is never going to trigger a financial crisis in any of these three countries. It's excessive private sector debt, and especially household debt, that's the concern. And if you were to push the New Zealand government's budget towards surplus again post-pandemic, you would be weakening private sector balance sheets and either pushing the economy back into a slump once more, or pushing the household sector towards an even higher level of household debt, and making the financial system and the eventual potential correction, the financial system more fragile and the eventual potential correction more severe.
Where do banks fit in when you look at the world through an MMT lens? Are they currency users or issuers, or a bit of both?
They can create a form of money, but they cannot create currency. When we talk about currency in MMT, we are talking about, I guess we're talking about physical currency, but there isn't very much of that. We are principally talking about the reserves which private banks hold electronically at the central bank. And they can only be created as a result of central government spending, which puts additional funds into those reserve accounts, or lending or asset purchases by the central bank. The private banks themselves cannot create those. Of course, when people think about the money supply more generally, they have a broader view of money. So they don't just include what I've called currency. They also include the deposits which people like you and I have at our banks. And it is true that our banks create deposits every time they lend. You go to your bank and you take out a loan. Then at the same moment, you sign the loan agreement, which is a financial asset for your bank. The bank gives you a deposit on which you can draw, which is a financial liability for your bank. And that deposit is included in measures of money. So when banks lend to us, when private banks lend to us, they create money, and they're licensed to do so by the banking regulator. They can only do this because we regard those deposits as money, and they're used as a medium of exchange in the economy. But they only have that status because we have a guarantee that we can convert them into government currency at par, dollar for dollar. And that is only possible because those private banks themselves have access to these electronic reserves at the central bank, which are used to organise the millions of transactions which take place in the economy every day as transfers of funds between those banks. And when the banks need additional reserves under normal circumstances prior to the pandemic and quantitative easing, in order to avoid interest rates rising above the Reserve Bank's target level. In order for the Reserve Bank to keep control of interest rates, the Reserve Bank supplies additional reserves to the banking system. The banks themselves don't create those reserves. They are created by the Reserve Bank in order to keep control of interest rates, and they are also created as a result of spending by the central government. So that's how it all fits together. We could technically do without a private banking system because we have the technology these days whereby we don't need the private banks to run the money transmission system. We could all theoretically have accounts at the central bank. There's no reason we couldn't do that now. But the reason why, apart from just historical reasons, the reason why we maintain a private banking system basically is because we have faith that private profit-making institutions that are well regulated will make better decisions over which businesses and which people to lend to than a government bureaucrat would. Other than that, the private banking system is unnecessary, but it's basically sort of a franchisee. The government and the central bank has franchised out to private banks the right, under the circumstances I just described, to create credit, to create money for people to spend. And they're able to do that because they have access to the currency which the central bank and the central government issues. That's basically the way that the system works. The trouble, of course, with this money that's been created by the commercial banks is it has to be repaid by people. So if you have dollars which either you've borrowed into existence or which somebody else in the private sector has borrowed into existence, those dollars can fuel economic activity now, but they're like a brake on the economy in the future because you set up debts that people have to service and repay. It's different when we're talking about dollars that we've got in our bank accounts that government spent into the system, because those are dollars that the private sector has that the private sector hasn't got to repay. So not all dollars are equal. That's what I'm saying.
Central banks, now, obviously you'll be familiar that the concept of the independent central bank that targets inflation is a very embedded, strong one here in New Zealand, dating from the 1980s, really. What should be the role of a central bank when you're looking through an MMT lens?
Well, first of all, we have far less confidence in the ability of central banks to do what everybody thinks they do. Central banks have a degree of independence, but that degree of independence was granted to them in the past as a result of legislation passing through Parliament. So in the end, it's Parliament that's in charge. As people say about the Federal Reserve in the US, it's a creature of Congress. It's responsible to Congress. In Australia and New Zealand, the central bank is ultimately responsible to Parliament and operates under a legislative framework laid down by Parliament. So there is a form of independence. I don't know exactly how the New Zealand Central Bank works, but our Monetary Policy Committee, our Monetary Policy Board, I should say, getting confused between UK and Australia, in Australia, has members who are appointed to the board by the government. Yeah. The governor of the Reserve Bank of Australia is appointed by the government. So it's a limited form of independence. Senior executives are appointed by the government. There's a legislative framework within which the central bank operates. I've got no particular objection to a nominally independent, at least for this purpose, central bank making interest rate decisions in pursuit of an inflation target, apart from to say that that model doesn't work anymore. And I don't think it works in New Zealand either, for the same reason it doesn't work in Australia, which is that if you go back to the early 1990s, or in the case of New Zealand, the late 1980s, you're looking at a country with very little private debt, very little household debt compared to now. And under those circumstances, if the economy wasn't growing fast enough, and there was a danger of inflation being below the target range of the central bank, then you can deregulate the financial system further than you already had. You can cut interest rates to encourage people to take on more debt, and that will help to push the economy forward for a while. But as I was saying before, there is a cost of that, and the cost of that is you're adding to that private debt, and you're also putting additional upward pressure on asset markets, especially the property market as well. And for a while, that can work. For a while, you can grow your economies based. We used to say the Australian economy was on the sheep's back. I don't know whether you said that in New Zealand, but
yeah,
in recent times, the economy's very often been on the back of household debt, growing household debt. And the household debt to income ratio has been rising and rising and rising. Between the mid-90s and the mid-2000s, it trebled in Australia. And we now have a situation where there's nearly a ratio of 200% behind gross household debt in Australia, between gross household debt and household disposable income or after-tax income. And New Zealand is not far away from that. Now, once you get to that level, cutting interest rates when inflation is below target and unemployment's too high, you think, to try to give some impetus to the economy, it doesn't work anymore. That's where we are now. So the problem is not so much that the model that we have doesn't stop you from limiting upward pressure on inflation. Because actually you wouldn't need to put interest rates up very much before you trigger a financial crisis in those countries. People defaulting on their mortgages, especially now. But it's in the other direction. The central banks are stuffed. There is literally nothing the Central Bank of New Zealand can do to create inflation. If they're missing their inflation target on the low side, or if there's negative inflation. Interest rates are virtually zero. It really doesn't work to have negative interest rates. Central banks are going off that idea because not much in those parts of the world where there have been negative official interest rates. So I guess what I'm saying is that people focus on central bankers as though they're all powerful. And I'm saying the model's broken. Keynes talked about this in a similar kind of context in the 1930s when he said under these circumstances, cutting interest rates to try and bring about economic growth is like pushing on a string. That's where we are now. So where economic recovery is concerned, there is nothing that the Reserve Bank of New Zealand can do, literally nothing. They can help the banks not crash, maybe, if there are problems with rising defaults. But they can't do anything to promote demand. Households are not going to borrow a lot more, whatever happens to interest rates. Businesses won't borrow for investment if they don't think there are any customers there. So the only game in town in the foreseeable future is fiscal policy. And governments, including the New Zealand government, will need to run significant, what we would until recently thought very high fiscal deficits as far as the eye can see. And if they are foolish enough to think that they need to move towards balancing their budget in the near future, in an economy with high levels of unemployment and underemployment and insecure employment and no obvious inflation risks on the horizon, then all they'll do is prolong the slump and maybe trigger that financial crisis that would have happened anyway if the Reserve Bank had increased interest rates, because if people lose their jobs or remain unemployed, eventually there comes a point when they default on their mortgages.
One of the things that we're often told in New Zealand is we're a small country, which is true, and we don't save enough money ourselves, therefore we need foreign investment. How does that stack up when you look through an MMT lens?
Well, New Zealand needs foreign currency to the extent that it actually imports goods and services from abroad which are priced in foreign currency, and I guess foreign physical capital, equipment and technology too. But if we're talking about resources which are available in New Zealand, then they're all available for sale in New Zealand dollars. There is no shortage of New Zealand dollars. It is not the case that there is a limited amount of dollars there, as I was saying before, and oh my God, don't have enough dollars to do the things we need to do, so we go to China to get some New Zealand dollars. They don't create New Zealand dollars in China. They're all created in New Zealand. As we were saying, if you go and borrow from your bank, the bank will create a deposit at the bank at the same time that you sign the loan agreement. So businesses can borrow from New Zealand banks as they need to. And it's not the case. People have this idea in their head that somebody goes and saves some dollars in a bank, and then the bank goes and lends those dollars out to somebody else. They've got this, and again, the International Monetary Fund will tell them this. It's not just me that's saying it. They've got it the wrong way around. You can't save non-existent dollars. Dollars have to be borrowed into existence, either in the private sector or spent into existence by the government before they're available to spend. It's that way around. There is not a shortage of dollars. And where investment funds coming in from abroad are concerned, what do? They help to maintain the value of the New Zealand dollar on the foreign exchange market. They help to keep down the cost of imports. So again, that plays a role in limiting inflationary pressures in New Zealand. But that's all it does. Once you understand MMT and you understand how the monetary system works, some of these things are obvious, really. Are we going to run out of our own currency? No, we are the monopolists of it. We're where it comes from. It can't come from anywhere else. Does that mean that our relations with the rest of the world are completely irrelevant? No, it doesn't. And the reason why it doesn't is that potentially currency depreciation in New Zealand could put upward pressure on the New Zealand price level. And were that to feed into a spiral of increases in the cost of living and increases in wages to compensate, feeding into rising labour costs, potentially it could be inflationary. But again, it's inflation risk that's the issue. It's the only issue.
Just going back to the looming election here, now obviously it's against the backdrop of COVID-19 and unemployment is a lot higher than it's been in recent times. So if I was a politician and I wanted to promise a job guarantee scheme, or if I was worried about climate change, I was to promise some big schemes to tackle climate change, or if I wanted to cut taxes or increase military spending, or, you know, I'm worried about the rising cost of superannuation as the population ages. Through an MMT lens, tackling any of these issues would seem to be possible.
It is possible, but what you need to do before an election and before any budget is the planned spending and really the whole of fiscal policy needs to be considered from the perspective of inflation risk. And what I advocate for in Australia with our Parliamentary Budget Office, which is basically what Stephanie Kelton advocates for in the US with the Congressional Budget Office over there, is that they should continue, as they are supposed to do at the moment, to assess from a neutral perspective the fiscal plans of, before an election, a government and an opposition, or during a parliament, the plans, spending and taxation plans of the government. But they shouldn't be trying to forecast years in advance the implications for the budget balance itself, because the budget balance itself is irrelevant, taken out of context of the state of the economy as a whole. It's always inflation risk, which is important. So they should always be looking at inflation risk, because when we say that our governments can never become insolvent, what we are saying is that there's no financial constraint, no purely financial constraint that they work under. but there is still a real constraint. So New Zealand has a limited productive capacity, limited by the labour and skills of the people and the capital equipment, technology, infrastructure, and the institutional capacity of business organisations and government within New Zealand. That limits the quantities of goods and services that can be produced in Australia. There's a limitation there. Also, it depends on the natural resources, obviously, of the country. List that out. If you spend beyond that productive capacity, it can be inflationary, and that can frustrate your objectives, frustrate what you're trying to do. So it's always inflation risk that's important. Within that productive capacity, however, what it is technically possible to do, the government can always fund. So yes, you can fund any of those things, but there's always an inflation risk. And that inflation risk is not specific to government spending, it's specific to all spending. So spending on goods and services produced in New Zealand, whether it's by the New Zealand government or private sector, or for that matter, the rest of the world, could potentially be inflationary if it goes beyond the productive capacity of the New Zealand economy. You need to take that very seriously. Modern monetary theory economists say the best way of doing that is to do a detailed microeconomic survey of those inflation risks. So you look at what you want to spend on. If you want to engage in infrastructural investment, what skilled labour is that going to involve using? What businesses are you going to be dealing with? Do those skills exist? Do those businesses have spare capacity? What materials are they going to use? Do they exist? Can you buy them? Are they in short supply? And then obviously you're also going to take into account the secondary effects, what we sometimes call the multiplier effects of that initial spending. If you're employing more people in that industry now, and those people are going to spend locally, is that likely to be inflationary or not? If you have inflation constraints, where might they come from? If they come from the power system, then over time, what can you do to increase capacity in that part of the economy? If there are shortages of skilled labour, what can you do to address those skill shortages? Those are the kind of things which we talk about. So some people, generally people who haven't read Stephanie Kelton's book and don't really know very much about monetary theory, they imagine we're saying it's wise for the government to spend without limit, or you can spend a lot more without ever worrying about high taxes or other approaches to limit potentially inflationary spending like financial regulation. And we're not saying that at all. Indeed, in our view, not only do we not ignore inflation risk, we take it a lot more seriously than people who say unrealistic and vague things about printing money causing inflation. Well, inflation is a result of prices rising. Prices can rise for a variety of reasons. If you want to make sense of them, when you're trying to engage in responsible fiscal policy, you need to look at where the inflation risks are coming from and address those risks. And where necessary, you have to deal with pay-fors, and those pay-fors may involve, if you want to spend more in one area of the budget, spending less in another. They may involve raising taxes. They could involve higher interest rates. They could involve tightening up on financial regulation. But they may involve other things too. It may involve scheduling what you're aiming to do in such a way that you have the capacity before you use do everything else you're talking about. Yeah, money's not the issue. That's the short answer. Things are.
Great. Look, Stephen, we'll wrap it up there. Really appreciate your time. That's Stephen Hale, lecturer at the University of Adelaide School of Economics. And I'm Gareth Vaughan at interest.co.nz.